If you were born before 1958 and you are married or were married, there is a specific Social Security strategy that can add $18,144 per year to your household's lifetime income, and that most couples in your birth cohort have never been told about clearly enough to act on it. Not a one-time payment, not a retroactive benefit that requires filing a new claim. A permanent annual difference in what your household receives from Social Security, determined by a single decision that is made once and cannot easily be undone. The decision is when the higher earner in your household claims Social Security, and the $18,144 figure is the difference in annual survivor benefit between a higher earner who claimed at 62 and a higher earner who delayed to 70. For the surviving spouse, who may collect that benefit for 10, 15, or 20 years, the total lifetime difference is enormous. My name is Linda Foster. I have spent 12 years as a certified retirement planner working with seniors across Florida and throughout the country. And the survivor benefit conversation is the one I wish I had been able to have with every couple born before 1958 before they made their claiming decisions. Because once the higher earner has claimed and is locked in at a reduced amount, the survivor benefit that the other spouse will eventually receive is also permanently locked in at that lower level. Let me explain exactly how this works, what the numbers look like for people born before 1958 specifically, and what can still be done for households that have not yet optimized this decision. For people born before 1958, the full retirement age is either 66 exactly for those born between 1943 and 1954, or 66 years and 2 months through 66 years and 8 months for those born between 1955 and 1957. This is different from the full retirement age of 67 that applies to everyone born in 1960 or later. The lower full retirement age for this birth cohort means that delayed retirement credits, which add 8% per year for every year you wait past full retirement age up to age 70, accumulate over a longer window. For someone born in 1953 with a full retirement age of exactly 66, delaying from 66 to 70 adds 32% to the full retirement age benefit. For someone with a full retirement age benefit of $2,000 per month, the delayed benefit at 70 is $2,640. The difference from claiming at full retirement age versus delaying to 70 is $640 per month. But the surviving spouse does not receive $640 more per month just because the higher earner delayed. The surviving spouse receives the higher earner's actual benefit at whatever level it was locked in when the higher earner first claimed. If the higher earner claimed at 62 with a 25% reduction, the survivor receives the reduced amount. If the higher earner delayed to 70 with a 32% increase above full retirement age, the survivor receives the higher amount. Let me put specific numbers on the difference. A higher earner born in 1953 with a full retirement age benefit of $2,800 per month. If that person claims at 62, their benefit is reduced by 25% to $2,100 per month. If they claim at their full retirement age of 66, they receive the full $2,800. If they delay to 70, they receive $2,800 plus 32%, which is $3,696 per month. When the higher earner dies, the surviving spouse receives whichever of the two spouses' benefits is higher. If the higher earner had claimed at 62 and was receiving $2,100, that is what the survivor receives. If the higher earner had delayed to 70 and was receiving $3,696, that is what the survivor receives. The difference between the survivor receiving $2,100 per month and receiving $3,696 per month is $1,596 per month. Over 12 months, that is $19,152. For a surviving spouse who lives another 15 years, the cumulative difference is $287,280. That is the number that changes how people think about this decision, not the monthly difference. The cumulative lifetime difference for the person who will be left behind. Now let me address the Social Security Fairness Act component, because this law changed the financial picture significantly for a specific group of people born before 1958 and it connects directly to the survivor benefit conversation. In January 2025, the Social Security Fairness Act was signed into law, eliminating both the windfall elimination provision and the government pension offset. These two rules had been reducing or completely eliminating Social Security benefits for people who also received pensions from jobs that did not pay into Social Security. Teachers in many states, firefighters, police officers, and government workers were all affected. For people born before 1958 who are now in their late 60s or older, many of them made household claiming decisions years ago based on the assumption that one spouse's Social Security benefit would be substantially reduced or eliminated by the government pension offset. A widow who never filed for a survivor benefit because she was told her government pension would eliminate it may now have a meaningful benefit available that she has never claimed. The elimination of the government pension offset means what was zero is now potentially hundreds of dollars per month. But the benefit does not start automatically. You have to apply. The Social Security Administration completed most retroactive payment adjustments to existing beneficiaries by mid-2025. But widows and widowers who never filed because they were told their benefit would be zero have not received any payment because there was no active claim on file. If you are a widow or widower who received a government pension from a non-Social Security covered job, and you were told years ago that the government pension offset would eliminate your survivor benefit, call the Social Security Administration at 1-800-772-1213 this week. Ask specifically whether you have an unclaimed survivor benefit under the Social Security Fairness Act. The retroactivity of any benefit you are owed is limited, meaning every month you delay is a month of benefits you cannot recover. Now let me address the earnings record dimension, because for people born before 1958, this is the component that most consistently reveals overlooked money. Your Social Security benefit is calculated using your 35 highest earning years. If your earnings record contains any year that shows lower earnings than you actually had, or any year that shows zero when you know you were working, your 35-year average is artificially low, and your monthly benefit is permanently reduced as a result. For people born before 1958 who are now in their late 60s, 70s, or 80s, the potential for earnings record errors is higher than for younger cohorts. Records from the 1970s and 1980s, when record keeping was less automated, are more susceptible to transcription errors, missing data, and employer reporting failures. Women who change their names following marriage may have early career earnings recorded under a different name that were not correctly linked to their current Social Security number. Log into your My Social Security account at SSA.gov. Review your complete earnings history year by year going back to the beginning of your working life. If you find any year where the earnings shown are significantly lower than what you know you earned, or any year with zero where you were actually employed, that discrepancy is worth investigating. You can request an earnings record investigation by calling 1-800-772-1213. You will need documentation from the relevant years, ideally W-2 forms, tax returns, or employer records. For very old years, the Social Security Administration has their own records and can sometimes resolve discrepancies without documentation from you. The investigation process takes time, but a corrected year that adds meaningful earnings to the 35-year average can increase your monthly benefit by $50 to $200 permanently. Now let me address the voluntary suspension option for people born before 1958 who claimed early and are now regretting the decision. If you have already claimed Social Security retirement benefits, the standard claiming decision cannot be undone. There is a 12-month withdrawal window using Form SSA 521 that requires repaying all benefits received, but that window is only available in the first year after claiming. However, if you have reached your full retirement age and you claimed before reaching it, voluntary suspension is available. Voluntary suspension allows you to stop receiving your benefit at or after full retirement age. For every month your benefit is suspended, you earn 2/3 of 1% in delayed retirement credits. For every year of suspension, you earn 8%. For someone born in 1955 who claimed at 62 with a 25% reduction and is now 67 and past their full retirement age of 66 years and 2 months, suspending from 67 to 70 adds 24% on top of the already reduced benefit. The result is not the same as having delayed originally, because the credits are applied to the reduced base rather than the full retirement age benefit. But the improvement is real and permanent. The specific situation where voluntary suspension is most compelling is when the higher earner in a couple claimed early, their spouse has not yet claimed, and there is time between now and age 70 to accumulate meaningful delayed credits. Even if the suspended amount is modest, the improvement flows permanently to the survivor benefit as well. Let me also address the divorced spouse situation for people born before 1958, because this is a group that consistently leaves money unclaimed. If you were married for 10 years or more and have since divorced, you may be entitled to a spousal benefit based on your former spouse's Social Security record. The benefit is up to 50% of your former spouse's full retirement age benefit. Your former spouse does not need to know you are claiming. They do not need to have filed for their own benefits, and your claim does not affect their benefit or their current spouse's benefit in any way. The divorced spouse benefit is available at age 62, with reductions for early claiming. At your own full retirement age, you receive the full 50% amount. The only requirements are that the marriage lasted at least 10 years, you are currently unmarried, and your own Social Security benefit is less than the divorced spouse benefit. Many women born before 1958 who had lower career earnings than their former husbands and who have been living on their own modest benefit or on a government pension are entitled to a meaningfully higher divorced spouse benefit they have never claimed. The application is made through SSA.gov or by calling 1-800-772-1213. Let me close with the complete action list for people born before 1958. Review your My Social Security earnings record at SSA.gov for any errors or missing years. If you find discrepancies, call 1-800-772-1213 and ask about the earnings record investigation process. If you or your spouse has not yet claimed and is past full retirement age, calculate the benefit at 70 using the estimator at SSA.gov. The 32% delayed credit for someone with a full retirement age of 66 is the largest delayed credit available under current Social Security law, and it flows permanently to the survivor benefit. If you received a government pension and were told the government pension offset would eliminate a spousal or survivor benefit, call 1-800-772-1213 this week about your Fairness Act eligibility. If you claimed early and are past your full retirement age, ask the SSA about voluntary suspension and the benefit increase it would produce by resumption at 70. If you were married for 10 years or more and are divorced, confirm whether a divorced spouse benefit is available on your former spouse's record and whether it exceeds your current benefit. The decisions available to people born before 1958 are some of the most financially significant available in all of retirement planning. The window is not unlimited, but it is open now. Send this video to one person in your life who was born before 1958 and who you know has never had a complete conversation about survivor benefits and the household claiming strategy. That conversation could change their financial security for the rest of their life. I will see you in the next one. Let me go deeper on each of the key issues because the practical details are what allow you to actually act on this information. On the survivor benefit calculation, I want to address a specific misunderstanding that affects a large number of couples in this birth cohort. Many people believe that the surviving spouse receives half of the deceased spouse's benefit. That is the spousal benefit rule, not the survivor benefit rule. The spousal benefit, available while both spouses are living, is up to 50% of the other spouse's full retirement age benefit. The survivor benefit, available after one spouse dies, is up to 100% of what the deceased spouse was actually receiving, including any delayed retirement credits they accumulated. This distinction is critically important. A higher earner who delays to 70 and receives $3,696 per month does not leave a survivor benefit of half that amount. The survivor receives the full $3,696, not $1,848. The survivor replaces the higher of the two household benefits entirely. For a couple born before 1958, where both spouses have been receiving Social Security for some years, this means the surviving spouse will receive whichever monthly benefit is larger when one spouse dies. If the higher earner had delayed and is receiving $3,600 and the lower earner is receiving $1,400, the survivor receives $3,600 per month going forward. The lower earner's own benefit stops. Understanding this clarifies why the higher earner's claiming decision is so consequential for the household. It is not just about the higher earner's own lifetime income. It is about locking in the floor beneath which the surviving spouse's income will never fall for the rest of their life. On the Fairness Act and the specific documentation needed for people filing new claims, I want to give practical guidance on what to gather before calling the SSA. When you call 1-800-772-1213 to inquire about a survivor or spousal benefit under the Social Security Fairness Act, the representative will likely ask for your Social Security number, your former spouse's Social Security number if you have it, the dates of your marriage and the deceased spouse's dates of birth and death, and documentation of your government pension if one exists. Having these items available before you call makes the conversation more efficient. If you do not know your former spouse's Social Security number, the SSA can often locate the relevant record using the deceased spouse's name, date of birth, and approximate state of residence. The SSA has their own records from the deceased spouse's working years and can match them to the survivor's claim. The retroactivity question is important to address before you hang up. Ask the representative specifically how far back your benefit payment can be retroactive. For some survivors who never filed because the offset would have produced zero, the retroactivity may be limited to months since the Fairness Act became effective in January 2024. For others, different rules may apply. Getting a clear answer on retroactivity before ending the call allows you to understand the full financial picture of what the benefit is worth. On the earnings record investigation, I want to address the specific documentation situation for people whose careers included periods in the 1960s, 1970s, or early 1980s, when paper-based record-keeping meant that errors were common and documentation may be difficult to locate. For earnings from 40 to 50 years ago, original W-2 forms and tax returns are often no longer in the individual's possession. However, the IRS retains tax records indefinitely in some form, and the Social Security Administration has their own records of earnings reported by employers. The SSA's investigation process involves reconciling their records with IRS records, and in some cases, errors are identifiable and correctable without any documentation from the individual. For people who believe they have earnings record errors from early in their careers, the starting point is calling 1-800-772-1213 and asking for an earnings record review. Describe the specific years and the approximate employers involved. The SSA will indicate what investigation they can conduct and what documentation, if any, would be helpful. If original documents cannot be located, the SSA sometimes accepts alternative evidence such as union membership records, pension fund records, Social Security card applications from the relevant period, or affidavits from former coworkers or supervisors who can confirm employment. On the voluntary suspension strategy, I want to address the interaction between suspension and Medicare, because this is a practical complication that affects some people's decision. When you voluntarily suspend your Social Security benefit, your Medicare Part B premium, which is typically deducted directly from your Social Security check, can no longer be deducted automatically. You must pay the Medicare premium separately, either through automatic bank payment or by quarterly billing. For most people, this is a minor administrative adjustment rather than a substantive obstacle. But it is worth knowing before you suspend, so you can arrange the alternative payment method and avoid a premium lapse that could affect your Medicare coverage. The suspension also affects the Social Security benefit of anyone claiming on your record. If you have a spouse who is receiving a spousal benefit based on your record, and you suspend your own benefit, your spouse's spousal benefit is also suspended. This means voluntary suspension is generally not compatible with a situation where the lower earning spouse is already receiving a spousal benefit based on your record, because both benefits would stop during the suspension period. The lower earner would need to have their own sufficient independent benefit to live on during the suspension period for this strategy to be practical. On the divorced spouse benefit, I want to address a specific planning consideration for women born before 1958 who are currently receiving their own modest retirement benefit and who have been divorced from higher earners. The divorced spouse benefit is calculated as 50% of the former spouse's primary insurance amount, which is their full retirement age benefit, regardless of when the former spouse actually claimed. If your former husband claimed at 62 with a reduced benefit, your divorced spouse benefit is still 50% of what he would have received at full retirement age, not 50% of his reduced actual benefit. This distinction can be significant. A former spouse who claimed at 62 with a 25% reduction and is receiving $2,100 per month had a full retirement age benefit of $2,800. Your divorced spouse benefit would be based on 50% of $2,800, which is $1,400 per month, not 50% of his actual $2,100 received. If your own benefit is currently less than $1,400 per month in this example, filing for the divorced spouse benefit increases your monthly income to that amount. The application does not require contacting your former spouse. The SSA has the relevant records from his working career. For divorced women born before 1958 who had lower career earnings than their former husbands and who are currently receiving their own modest Social Security benefit without having checked whether the divorced spouse benefit is higher, this is the specific calculation worth making. Log into SSA.gov and request your benefit statement. Then ask the SSA to provide you with information about the divorced spouse benefit available on your former husband's record and how it compares to your current benefit. One more consideration for the born before 1958 cohort that connects everything I have described. This generation includes a significant proportion of women whose careers were interrupted by child rearing, caregiving, or societal expectations of the era that limited women's workforce participation. Those interrupted careers mean 0 years in the Social Security earnings calculation for each year not worked, and those zeros permanently reduce the 35-year average. For women in this situation, the divorced spouse benefit on a former husband's stronger record or the survivor benefit on a deceased husband's record may be significantly more valuable than the personal retirement benefit built on their own interrupted earnings history. The specific numbers need to be compared, but the potential that a spousal or survivor benefit substantially exceeds the personal benefit is higher for this cohort than for any other. The complete picture for a woman born before 1958 should include her own retirement benefit at several claiming ages, the survivor benefit if her husband has passed away or when he eventually does, the divorced spouse benefit if applicable, and the interaction of all these with her current income and future income planning. No single number tells the complete story. I will see you in the next one.